we're going to let you know some of the details of the conversation we had on Thursday evening. We did one of our regular quarterly client educational dinners over at the Country Club of Orlando and had some good information to share, right? That's always good when you want to have a educational dinner, that you actually attempt to educate folks as to how investments and the economy and the headlines all interact together. So we're going to be talking about that for those that miss, although we had a pretty good crowd, about 180 odd folks there on Thursday evening. Also had a number of folks on the Zoom option as well. So we'll talk a little bit about the latest and greatest that we heard from an investment portfolio manager, what they're seeing in terms of the landscape for the road ahead. Plus, of course, we'll talk about our latest blog post. Talked a lot about Social Security. You know, every month we do a lengthy blog post, and it covers a variety of topics. So we want to tell you about the most recent blog posts on the website as well. Plus, we'll give you the latest in terms of some cybersecurity stuff. We've talked about this before. Tax season, which is what, of course, Americans are in the middle of, is a great opportunity for the fraudsters to attempt to trick you and get your personal information. So we wanted to share some information on that as well. So welcome to the program. As we do each and every week, we got a full lineup of things to talk about. We happen to be Central Florida's longest running radio program, coming to you on a variety of networks throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you're subscribing to us over there on your favorite podcast channel of choice. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So if you're keeping score, so to speak, on the markets each and every week, and I guess that's okay. The word of caution is always, if you look at stuff too often, you might start losing your hair, because remember, markets, investments, they go up and down. So be careful at how frequently you check and watch this stuff. But another positive week despite all the headlines, right? The S&P 500 was up about 2% for the week. Over the course of the past 2 weeks, it's up about 8%. Now, that's just another example of why it's so hard to predict what the market is going to do in the short term. Here we have a slew of headlines, people basically going broke at the gas pump, the war in Ukraine, and lo and behold, best couple of weeks for the markets in over a couple of years. What also happened, though, was bond yields rose. And I think this is the more important story longer term in terms of its impact, because when the 10-year yield on the Treasury, so when you think about that Treasury and how that works, the 10-year yield on the Treasury drives a lot in terms of mortgage rates and borrowing costs, even more so than the Federal Reserve, because the markets can kind of drive those yields up on the Treasury in anticipation of what the Federal Reserve is going to do. Very clearly, the Federal Reserve is going to raise rates, so consequently, you're already sort of seeing that priced into the bond market. Well, lo and behold, the yield on the 10-year Treasury, which is often a proxy for kind of mortgage rates or what mortgage rates are based off of, went all the way up to nearly 2.5%, 2.491%. And that's important. That's probably the biggest development, if you will, in terms of the markets. It was really more on the bond side, because when you think about how that plays out, so we're going to relate that to real estate, right? So here are the numbers in terms of real estate. So the average single family home in America today appreciated nearly 55% over the course of the past 5 years, ending 12/31/2021. So value of homes have gone up. We certainly know that here in Florida. Mortgage debt, correspondingly, has also gone up. Mortgage debt approaching 11 trillion, reached an all-time high as of December 31, 2021. So I guess that makes sense, right? Because if you got to pay more for something because the value has gone up, then you wind up having to ultimately borrow more money to do that. And so as we see these values of the real estate go up, we're correspondingly see mortgage debt going up. But then here's how a slight shift in rates can impact those two items. So if you look at the average 30-year fixed rate mortgage at the end of February, it was about 3.89%. For every 100,000 you borrow at 3.89% on a 30-year mortgage, you're going to have a monthly payment of $471. That's the principal and interest part. Don't count the escrow and the escrow, because that's the taxes and the insurance. That stuff you have to pay anyway, regardless of whether you got a mortgage, right? So just look at the principal and interest part. So on $100,000, principal interest 3.89% end of February, the prevailing average 30-year fixed rate mortgage nationwide. Contrast that to just about 8 weeks before that, the beginning of the year, this year, a year ago, a beginning of the year, January of 2021, when you had your average interest rate cost on a 30-year fixed rate mortgage be at 2.65%. Isn't that amazing? That's just unbelievable when you stop and think about that. 14 months ago, you could borrow money on a 30-year basis for a house at 2.65%. When borrowing costs are that low, no wonder price goes up, right? Because you don't care. Because I can keep borrowing more and more money and I don't have to worry about that. See the U.S. government, if you need a better example of that, 2.65% as of 14 months ago. Here's the difference. That if you borrow $100,000 and the interest rate is 2.65%, your monthly principal and interest payment is only going to be $403. So in 14 months, on that $100,000, the cost has gone from $403 to $471. That's a 17% increase in your payment. Now you wouldn't think, looking at the interest rate, it's just a 1%. Went from 2 and change to 3 and change. That probably didn't change a whole lot, did it? Well, it actually does. And it's a 17% increase in payment. And that's just per 100,000. So if you're doing that at the 300,000 level or $400,000 level, well, now it becomes much more significant in terms of that payment. So we think the bigger story this past week is that continuing push up on the yield on the U.S. Treasury, because that drives mortgage rates, which does a whole lot of other stuff for the average American consumer. So certainly important to continue to watch that and just put that into your understanding of what happens when I borrow money and how that impacts the payment. We'll take a break and return after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Anyway, we had a client educational dinner during the course of this past week, and we thought it was important enough to share some of the information and some of the slides, or at least I'm going to try and describe some of the slides. If you're a client of the firm, then you know you already got a copy of these, so kudos to you. For the rest of you, we're going to try and describe some of it because we wanted to spend some time on these central concepts. Chief among them, of course, something that we talk about on the program here, is inflation. And certainly when we think about what is causing that, I think perhaps one of the most dramatic slides that we saw on Thursday was just the relative amount of cash, and what people like to refer to that as liquidity, but it's printing money and putting it into the economic system. There's no other way to describe it. And you hear about that. And again, I think here in this country we have a very kind of myopic focus on, if it's happening here, then it's happening here and nowhere else. But the reality is, when you think of the amount of cash that was put into the system as a result of COVID obviously a worldwide problem, and so consequently central banks across the world were putting a tremendous amount of liquidity in. What that also does is, and let's face this part of it, when you think about putting excess revenue, excess cash into the economic system, it does drive demand for risky assets. It does have a tendency to create bubbles where you would not see bubbles. And so when you think of that, think about some of this cryptocurrency stuff, some of this non-fungible token stuff, some of this stuff that when you hear it, you're like, what the heck is that? And more importantly, why is it going up? Well, I think this slide that showed the relative amount of liquidity that central banks have pumped into the economic system during this COVID crisis is really pretty dramatic. And I guess the way to really underscore that is looking at the amounts of the dollars relative to what happened in the financial crisis of 2008. Because I would submit that the financial crisis of 2008 was a much more dramatic economic impact. Certainly COVID, a health impact, no question at all, with nearly 1 million Americans dead. But economically, the 2008 disaster, which caused people to lose their homes, get foreclosed on, walk away from their homes. That was a much broader and deeper economic crisis. But here are the numbers, and here's where the comparison kind of warrants a full discussion, because it is having a ripple effect. 2008, U.S. Central Bank, obviously known as the Federal Reserve, pumped about $2 trillion into the economy. On the other hand, the European Union, about the same, okay? And then the Bank of Japan, which is the sort of the Federal Reserve for the country of Japan, hit up another $1 trillion. So you add those two numbers together, and three major economies of the developed world, US, Europe, Japan, $5 trillion of excess liquidity pumped into the economic system in 2008. Now, let's fast forward to the year 2020, 2021, that period of obviously of COVID time. US pumping about $9 trillion. European Union pumping about $10 trillion. Bank of Japan pumping about $6 trillion into the economy. Add those numbers up, it's about $25 trillion, 5 times greater than what the central banks. And I'm not necessarily counting what happened in Washington in terms of the legislation and all, the tax cuts, things like that, stimulus. This is just the central banks, folks. So these numbers are pretty dramatic, and I would argue far less reaching economically in terms of the impact of COVID. So as you might well imagine, toss in increased demand, right? Toss in constrained supply, no question at all. Those are definitely at work out there. And now you have real rates, which is an expression that's probably gotten lost over the past 15 years, because real rates and actual rates were kind of the same because inflation was so low. But to reintroduce the concept of what real rates mean, real is how real it impacts you. So the real rate, when you hear that expression, that is in essence inflation adjusted. It's just sort of shorter way to say it, right? So it doesn't quite sound as bad as if you say inflation adjusted, because if inflation is raging, then wait a minute, that's going to have an impact. But if you say real, then hey, it doesn't sound quite so bad, does it? But the real rate, we have not seen this negative, again, inflation adjusted rate, since the 1970s. So something certainly important. And that's why I think the conversation on Thursday among our clients, and certainly in terms of the speaking, the presentation part, really had a lot of conversation about inflation. Good news, if you will, to the extent that there was some silver lining. Profit margin at corporate America is at an all-time high. Why? Well, you could argue, hey, that was cheap cash, and they were using the cheap cash and consequently doing a tremendous amount of share buybacks, which increases your profit margin, right? If you've got 1,000 shares outstanding and your profit is X, then your profit per share, X divided by 1,000, well, that's one number. If you borrow money cheaply at, like 2.5%, and then you buy back shares, well then, and you have the same profit, but you only got 900 shares outstanding, well, how the math works is that means your earnings per share will go up, hence profit margins at a pretty high level still, but some of that related to the extensive buyback types of programs. And then if you kind of continue forward and kind of look at valuation measures, pretty high, particularly on the U.S. side, large growth. We've certainly talked about that before. Interestingly though, the valuations, the relative valuations of companies and the markets in other places such as Europe, Japan, things like that, not as out of line, not as overvalued as what you would see here in the U.S. So certainly some interesting data points there. The last one has to do with stock concentration. The top 10 stocks and the concentration that they have in the markets, over 30%. If you look at the top 10 stocks and the amount of concentration they have in the market, it's over 30% today. Comparison purposes, in the tech bubble, that top 10 concentration was about 26%. So that's the information that was talked about, put out there in terms of some of the economic numbers. When we return from the break, we're going to kind of summarize all of that up and try and make some meaning of it, and more importantly, where you as an investor should go with that kind of a backdrop. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So in the prior segment, we sort of set the table based upon the presentation that one of the investment portfolio managers that we use made to our clients this past week at one of our firm's regular client educational dinner sessions. And just to kind of recap from that prior segment, we talked a lot about just how much stimulus has been pumped in by not just our central bank, but central banks around the world, particularly a 5x times more relative to what they did back in 2008. We talked a lot about inflation and the real returns, the inflation adjusted returns being at some of the lowest levels since the 1970s, particularly when you look at current interest rates and then add in or subtract out, if you will, the impact of inflation. On the good news side of things, certainly earnings per share more for corporate America. Some of that's due to share buybacks. Valuation measures, while they are high here in the U.S., certainly in the rest of the world, they're certainly a little bit more in line with where you would normally expect them to be. Throw that into that last factor that we've certainly talked about on the program many times before, and that is the concentration, if you will, of those top 10 holdings. You take the 10 largest companies and look at how they perform or how much they're driving the index of the S&P 500, and you stop and think about that from a relative point of view, right? 10 companies are on a 500 company index. Well, that's basically 2%. That 2%, mind you, is driving over 30% of the performance of the index. Does that sound like it might be a little concentrated? Yes, it does. And the reality is that if you go back to other periods of time where you've seen that concentration of just that small handful of companies spike up, the last time, of course, back in more of the tech era when the top 10 concentration got to about 26%. So already we're about 20% higher in relative terms than where things were back in 2008. So you've got inflation, you've got valuation, you've got concentration, all certainly things that don't exactly suggest a bed of roses for the investor out there. So what's the takeaway? What should investors be doing? Well, we got into that, and we're going to share that here in this segment about what you need to do as an investor with that kind of an economic backdrop, right? Inflation, largely as a result of huge liquidity in the economic system, courtesy of central banks around the world. Valuation, relative valuation, relative to where the markets would be valued on an earnings per share level normally. And then, of course, that concentration, small number of companies driving a lot of the performance. So we'll have those key takeaways for investors in this segment. Welcome back to the program. Of course, this is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a host of radio stations throughout the Central Florida region. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So, what are the takeaways for investors against that kind of a backdrop that we were just talking about? Well, and I know this is an oldie, but it's a goodie. Number one, be diversified, and intentionally so. Listen to those concentration numbers once again. 2% of the index, the S&P 500, driving nearly a third of the performance of that index. Folks, that's a little high. That's not being as diversified as you should be. That's being a little bit more concentrated. You should be able to look at your investment portfolio. And if you want to be fully diversified, look at your top 10 holdings. Add up the percentage of your portfolio that is in those top 10 holdings. How much is it? Is it 30%? Well, then that seems like you're just going lockstep with the market. Is it more than 30%? Well, my goodness, then you're even more concentrated than the overall stock market. Is it less? Okay, well, now you're starting to avoid the concentration issue. We like to see those top 10 holdings to be about 15 to 20% of the overall portfolio. Once you get past that, then you're starting to reduce down your diversification. And certainly as an investor, if you're just simply blindly tracking the indexes, then you in fact have a less diversified, more concentrated portfolio than what we would recommend. Number two, be aware of the bonds, right? I mean, the real return, the lowest since 1970, basically a nice way of saying inflation adjusted, and the impact that inflation has in eroding returns and results and things like that. So beware on the bond side, right? I mean, the absolute return there isn't going to be particularly high. And then if you adjust it to make it real, then ultimately it winds up being a much bigger negative number than I think people realize. And then number three, I think it's important to kind of consider elsewhere. I think particularly over the past 10 years, a lot of portfolios have gotten more and more concentrated here in the US. Understandably so. All of those large tech companies, the FANGs, you've heard us talk about that before. That's certainly an expression that gets used in the business media. Facebook, Amazon, Netflix, Google, Apple. Those companies really have driven a tremendous amount of the performance of the overall market over the course of the past decade, leading to this higher relative valuation for the US markets, particularly on the large growth side, than what you would typically see as being normal. So it's important to make sure that you're not overly concentrated here in the US. Consider non-US regions as a way to help not just improve the diversification, but maybe to address this valuation issue. So certainly important to be kind of thinking about those types of things as it relates to your overall investment portfolio and how to deal with what are very clearly some major factors that are going to have some impact over the course of the next few years in front of us. So some important takeaways, certainly a valuable, or at least we thought valuable conversation and educational dinner session with our team and our clients on this past Thursday. All right, so speaking of time frames, obviously we're in the middle of tax season. Just a word of warning, if you will, on the tax side of things. That's when emails and things like that and the scams really ramp up, because you've got that taxes on your mind, and so consequently it's easier to fall victim to some of the email scams and frauds that are out there. And one of our clients actually warned us of this in an email that we wanted to be sure and share with you here on the program. So Randy, we thank you for the email because we think it's important. Anyway, he emailed us and said he had gotten 3 different emails from something called tax saver, tax slayer, or something. Anyway, it was 3 consecutive emails. And here's the thing that we want you to know about is understand what it is, and so that if you see it in your inbox, don't click on it. So it was a series of 3 emails. Email 1 that says notice a receipt. Second one said there was a problem with your return. Third one was we can help. The problem is when you click on that one, the we can help, they're going to ask for all of your personal information, and those emails are not legitimate. So stay clear of those. If you get a series of emails that says, oh, we got your tax return. Oh, wait a minute, there's a problem. Oh, wait a minute, we can fix it. Watch out for those, because those are not legitimate emails. So just be careful out there, folks. It's tax season, and certainly the scams are on the rise. So with that, we'll take a break and return after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Welcome back to the program. This segment, we're going to be talking about our latest blog post on our website at Nelson Financial Planning. We encourage folks to go to the website and visit it often. Not only do you get to see this program, because obviously we take this, we convert it over into an audio file, we put it up on a variety of podcast channels throughout the internet, but you also can read our latest thoughts, and we usually try and do a blog post about once a month. And so we did one just recently and put it up on the site. We thought it was important enough to kind of talk about some of the things that we were thinking about as we put together that blog post. So welcome to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So this month's blog post had a bit to do with Social Security, the detailing the Social Security changes for the year 2022. Among those changes, chief among them, is that the earnings base, the amount of your earned income, your paycheck income, that now is subject to Social Security taxes, increases. It increases every year. It's now up to $147,000, up from $142,800 last year. What that means is up to $147,000, you've got to pay the 6.2% tax for Social Security. Your employer also matches that as well. Once you're above the 147 number, well, then you don't have to pay anything more into Social Security. That's one of the areas that folks in Washington are looking at maybe changing even more so, given some of the projected shortfalls in Social Security. The earnings threshold for year 2022, and this is important for folks that are collecting Social Security, but they're under their full retirement age, but they still want to maybe work a little bit, pick up some extra spending money or what have you. That earnings limit increased to 19,560 for the year 2022. That means that you could be working part-time, whatever the case may be, earning up to that number, and you do not have to give back any of your Social Security. Go above that number, again, if you're under full retirement age, which for most people is approaching 67, then you wind up having to, if you're under that number, you can keep all your Social Security. If you're over that number, then you wind up having to give back some of that Social Security. COLA adjustment, of course, we know that was about 5.9%. And then lastly, the Medicare Part B premium did jump up from $149.50 to about over $170. So wow, that's a 14% increase. Effectively takes that COLA that was at close to 6% down to about 5% instead, because that Medicare Part B premium increase sucked up some of that increase in your Social Security. Also, the blog post talked a little bit about some of the changes in terms of customer service. Good that the government is thinking about that. In some ways, making it easier for you to be able to get online and to do things like upload information or apply all online. Certainly, one of the things that we encourage at the office, our fellow certified financial fiduciary, Rob Field, also is a national Social Security advisor. Is one of the biggest things that he recommends for clients to do and for everybody to do is to go ahead and create a profile on mysocialsecurity.gov, and then that will allow you to see what your numbers are and be able to kind of use that as a tool to project and ultimately make some decisions as it relates to Social Security. Also, the blog post, much like we were talking about last segment, the scams are out there. Obviously, this time of year, the tax scams are a little bit more likely to happen, but there's always Social Security scams out there at all. A total of $45 million in Social Security benefits were lost to scammers. Average loss per incident about $5,800. So pretty significant. Folks, watch out for the fraudulent phone calls. Watch out for the fraudulent emails. Watch out for somebody that is calling to demand an immediate payment, those kinds of things. That doesn't really exist. And so if you see that, if you get a phone call out of the blue or you get an email out of the blue, best thing you can do is ignore it. Don't pay any attention to it. The reality is that's how a lot of these scams work. That is such a big issue out there in society as a whole. The more technologically advanced that we get, the more everything is, oh, just do it online, or oh, don't talk, don't call a customer service number. Heaven forbid that somebody actually is going to answer the phone. Go online and figure it out. Well, the problem is that scammers know that, and that's why you see a lot of this being internet or email types of things. And so consequently, that's just a risk that we have in society today. And then lastly, the blog post that we put up also talks about the top retirement fears. And so we boil it down to 3, although I'm sure there are many others out there. Chief among them, of course, is outliving savings and investments, and certainly basic financial planning while you're working. Using the concept of paying yourself first is a great way to set yourself up to avoid that in retirement, because obviously the notion of running out of money, outliving your savings and investing, becomes even more important now. Well, really for 2 reasons, right? People living longer, and then of course if you do have inflation, well then that's going to erode the purchasing power of that money over time more than it has over the course of the past 15 years. So, and then next is long-term care costs. So obviously medical costs, one of those costs that are increasing at a pretty dramatic pace. And so consequently, that becomes a big part of how you approach retirement in terms of budgeting for that. We often say that between the IRS and your healthcare costs, those are 2 things that you don't necessarily think about when you're planning for retirement, but they have to be in there as part of that as part of a line item on that budget. And then lastly, and this kind of ties into Social Security and some of the things we were talking about Social Security is this notion that Social Security is going to end. Certainly the program, not in the best financial shape, but there's a lot of ways in which they can easily improve that. Raising the age, raising the taxable wage base, like we were talking about earlier. Those are the kinds of things that they can do that would really help to shore up Social Security. And there's enough people that are on Social Security that vote that ultimately as we go forward, we would expect to see more and more emphasis and focus on Social Security and ultimately how all of those numbers will play out. So those are some of the retirement fears. You can learn and read much, much more about those Social Security topics, those Social Security changes, the Social Security scams, and those top retirement fears by simply going to our latest blog post on our website at Nelson Financial Planning. So make sure you go there and check it out. All the good, valuable information that's there, particularly in our blog post. So with that, we will wrap it on up and get on out of here. Enjoy the rest of the Sunday. Beautiful day out there, a little bit cooler, so that's always good. Living here in Central Florida, pick up those cool, sunny days. Enjoy the rest of your Sunday. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning.